that there's still a lot of average investor money coming into the market on a daily basis. There's this kind of thought process that every dip is a buying opportunity. So until proven otherwise, you're going to coax money into the market on these days where the market's trying to sell off, but then new money's pushing it back up. So remember, corrections, when you look at when crashes happen, in generally the big moves come at the end of a down move, not at the beginning. And the reason they don't come at the beginning is because at the beginning, everyone is still very optimistic. People are still greedy. You're still seeing the meme stocks pretty hot. So there's a lot of money that wants to be in the market and it's not scared yet. Once you get scared money later on, that's where the acceleration to the downside should come. Institutions have great minds, even better than me, and they're very aware of this break, and they're probably in their boardrooms right now deciding, do we start to unload quicker? One of the things I pointed out to a lot of people over the last 2 to 4 weeks is that we've had multiple days where the markets open higher, and then you'll see the first hour of selling pressure. I'm trying to look on my charts to see if I can show this here. Let me see here. So you can see on the spiders, like right here, it opened higher and sold off. Over here, opens a little bit higher, sold off. Opened here, sold off. Opened over here and sold off. And to the average investor, that may not seem significant. And again, this is the 10-minute chart, so this is looking on an intraday micro basis. But what that's telling me is when you see selling from the opening print early in the day, that's institutions selling when there's volume present in the market. So an institution can unload a multi-million-dollar position over lunchtime when there's no volume in the market. They have to pick their spots so that they don't crash the market. And what we're seeing again for literally the last month is this continually happen where the markets open up, then the selling comes in, and then around lunchtime or late morning, it subsides and the markets float back up, much like yesterday. Yesterday was a great example. We floated right back up into the end of the day. That's a signal I've been noting that also tells me that there's distribution going on in the market and investors should be aware. Yeah, so I mean, every short has to have a long, so keep in mind, but basically the volume kicked up as soon as the Fed, I mean, you can see right here, this is where the Fed announcement came out on Wednesday, and look at the spike on volume and then continued yesterday, and then obviously with the drop today, a lot more participants. So it's basically telling you that there was some sort of shock to the market that triggered people to either want to buy or sell. In this case, with the markets trading lower from that point, it was a net sell. When the put-call ratio gets down to below 0.5, at least historically 0.5, which means there's a really huge amount of calls versus puts, I always have looked at that as a contrarian indicator. The one thing I will say about that is it stopped working when the meme stock trade began, because what investors were doing is you saw millions and millions of small investors buying calls, and they were buying calls that were way out of the money, but it really skewed that index or that signal for me as a trading signal. So I think as a bigger macro view, yes, the put call ratio is important, but I used to follow it on an intraday basis, and you could actually short the market and go long the market based on the put call ratio. You can't do that, at least in the current period, on a micro basis.
Even for something as broad as, like, let's say the SPDR ETF?
Yeah, so believe it or not, the SPDR ETF we've seen a put call ratio overall very, very low on the SPDRs for quite some time, as the bullish bets have just been enormous in terms of buying calls. And I think in the overall market, I mean, even though individually they might not have millions of dollars, combined when there's tens of millions of them, they add up to a pretty hefty institutional force. So just like the last time we talked, I'm net short the market. I do have certain longs out there. I still continue to like, stocks like Viacom, even though that's kind of been just hovering in a range for months now. I've been a little frustrated that it hasn't gotten a better bounce, but I feel okay holding a stock like Viacom, and we can bring it up here on the chart and take a look. You can see it's down 12 cents today, but if you look at the chart here, It really hasn't done a lot, right? I mean, you had the Archegos Capital collapse and then it settled right in here. So for me, quality names are probably where you want to be, ones that pays dividends, one that have low PE multiples. I still think interest rates are eventually going to spike dramatically higher. I know people are even talking deflation again. I don't think that's going to be the outcome. So I definitely am focused on quality names, individual names, while being net short the indices. I think that the spike, I mean, you've seen crazy spikes, right? So, I mean, we're not just back on commodities to levels that we saw before COVID, whether it was copper or lumber or almost any other commodity. We're sharply higher. Now, those have started to correct, which is just natural considering the insane moves that we saw. For instance, lumber 300% move. I mean, ridiculous. But my guess is this: is you're going to see 5-6% inflation potentially in the near term. It will come back down, but I do not think it's going to come back to that goalpost for the Fed of 2%. And I think the Fed, again, based on what Bullard said this morning, and even what Jerome Powell was hinting at in his conference on Wednesday, you have to think that they're starting to realize that longer term inflation may be 3%, 3.5%, maybe even 4%, which means they need to get on the ball and start tightening things. I'm surprised, honestly, they're still buying 120 billion in bonds, mortgage-backed securities. I mean, the housing market certainly doesn't need that, considering the bubble building and housing market, and they're helping that bubble. They're creating it and pushing that thing. I honestly couldn't tell you where things are 10 years from now, but,
For sure.
but I'd be shocked if we get back below or at 2% in the next 3 years. So gold's such an interesting thing here, because you saw interest rates pop initially on the Fed that caused gold to sell off. And then you saw a more sell off yesterday when interest rates fell, which is very counterintuitive to what we're used to with gold. For me, this is more of a correction from an over leveraged position. So I think the fall with the Federal Reserve comments triggered something. And then you saw deleveraging in gold yesterday, continuing that move down. Now, the beautiful thing about charts is the charts are just so simple to read here. And I want to show everyone this. You guys obviously know about Fibonacci retraces. But if you just take this low pivot down here, which was the latest move up on gold, and you start a fib and you go to the recent highs, look at the exact level we hit yesterday and are bouncing off of today. It's the 618 Fibonacci retrace. So on a technical basis, so I bought some a couple days ago. I bought more gold yesterday. I had exited gold over here when we were starting to break to the upside. And now, again, I'm starting to accumulate. So for me, this is a very simple trade, which is that gold will continue to outperform, even if it has these short-term corrections. There are buying opportunities. There's going to be a continued gold bull market. The more money that gets printed, the higher gold will ultimately go, even if interest rates do go higher.
Outperform what exactly, Gareth?
I think it has a shot to even outperform the stock market over the next 12 to 18 months. So I expect potentially negative returns in the market, while gold, I think, could be by the year end 2,100, and then by the end of maybe 2023, even 2,800 to 3,000. So silver's a tricky one, because again, you still have kind of stuck in this range. So you have had a hit on silver the last couple of days. I would be a buyer of silver down here on the SLV just below 24, so a retrace to this trend line. What I wouldn't want to see is silver break below. So if it starts trading down to 22 or 22 and a half, that would be a concern to me. But I do think I do think silver eventually breaks out of this wedge pattern and has a significant move up. I mean, you could be looking at $40 per ounce silver in the not too distant future.